Reliability was a qualitative characteristic, and we defined it as saying information is reliable if it is free from error, opinions, and estimates, and is based on data that we can check or verify. And to do that, we'll need a source document to verify it. So source documents are used to verify these figures. Well, what are they? So during our course, we've learned that for cash transactions, there's receipts and check butts. For credit transactions, there's sales invoices and purchase invoices. And then we had a whole bunch of other documents. We had memos, statement of accounts, orders, quotes, and so on. So when we talk about source documents to verify things, these are the items that we're referring to. So example 1, the owner of a business contributed a computer. The owner paid $5,000 when the computer was bought 2 years ago. The current estimated market value, which we call the agreed value, is $2,000. Explain how the computer should be valued in the firm's balance sheet. In the previous video, we looked at relevance, and we said if we were doing the relevant figure, we would pick $2,000, the agreed value, because that is going to affect our decision making. In this case though, if I answer this from a reliability viewpoint, so I identify, so always following our structure of answering theory questions, I define it. Only information which is free from estimates and opinions and can be verified with a source document should be included in the firm's reports. So I've only given the part of the definition that's appropriate. I left out the bit about being free from errors. That's not really the point of this question. However, I haven't related it to the question. I haven't said, all right, well, which value should we use? So I'm going to do that now by relating. So in this case, the computer should be listed at the $5,000 paid by the owner, which is in contradiction to relevance, but that happens. Sometimes theories contradict each other. And the reason why we're going to do that is there is a source document to verify it. Even though it's for a different entity, it's for the owner, there will be some sort of document, maybe a receipt or an invoice, that shows how much that computer was actually purchased for. The problem with the agreed value is it's actually an estimate. It might be an accurate estimate, but it's still an estimate. And that means it's not reliable, because reliability says something has to be free from estimates. There's always a conflict between relevance and reliability. So just using an example of a property, what if something went up in value? So we bought property for $500,000 2 years ago. In updating the current insurance policy, the owner had the property revalued by a valuer who estimated the property has gone up to $750,000. Well, how should it be valued really depends on the question and your opinion. Should you be relevant? And if you are, then you'll forget the old number and you'll update it to its current market value. If you're being reliable, well, you'll use the old figure, even though it's got nothing to do with today's value and it's way below what it's worth, we'd still value it at $500,000 under reliability. That's because there's going to be a source document to verify the transaction that took place. Let's look at another example. Because a business only has 3 debtors, the owner has decided to stop preparing a debtors schedule at the end of each period. Explain whether the owner is correct in making this decision. So I identify reliability and I'm going to define it. And this time I'm going to mention the bit about records being free from error. So information in the firm's records must be free from error, and there must be source documents to verify all amounts. Well, what's that got to do with the debtors schedule? It's going to help me, first of all, I'm going to say the owner's made the wrong decision, and that's because a debtors schedule acts as what we call a checking mechanism. I can check the total of the debtors schedule equals the balance of every individual debtor subsidiary account. That way, if there are any errors, I can identify them, and then I can go back and use the source documents to help sort of resolve the problem. So that way we can see that we only given the part of the definition that was appropriate about being free from error. This wasn't about estimates and opinions, so I didn't need to give that.